In the third quarter of 2025, something happened in global markets that almost no one in America or Europe paid attention to, but every serious investor should. The richest people in China quietly pulled $47.2 billion out of US stocks and moved it into physical gold sitting in vaults in Hong Kong, Singapore, and Switzerland. Not into Chinese tech, not into European equities, not into crypto or luxury real estate, into metal. Now, at first glance, you might shrug and call it portfolio rebalancing, another tax strategy used by billionaires who play a different game. But there's a detail here that should make anyone with a 401k, an IRA, or a portfolio of S&P 500 names very uncomfortable. This is the exact same pattern that appeared in 2006 to 2007, right before the housing bubble burst. Lehman Brothers collapsed, and the S&P 500 fell 57% in just 18 months, wiping out roughly $8 trillion in American household wealth. Back then, Chinese elites were the first major group of foreign investors to quietly sell US assets and accumulate gold, months before Western media even admitted something was wrong. They saw the cracks in the system early, positioned themselves off the grid of the dollar, and watched the crash from higher ground. Today, the numbers are bigger, the global debt load is heavier, and the move into gold is even more aggressive. So the real question isn't why Chinese billionaires just dumped $47 billion into gold. It's what they see coming in 2026 that you don't. In Q3 2025, the data wasn't subtle. It was a flashing red warning light hiding in plain sight. Chinese investors sold a net $47.2 billion in US equities, the largest quarterly liquidation by Chinese nationals since record-keeping began in 1998. But the real shock wasn't the selling itself, it was where the money went. According to the World Gold Council, the inflows matched almost dollar for dollar, $28.3 billion in physical gold bars and coins, $12.6 billion into gold-backed ETFs and allocated positions, and $6.3 billion into private vault storage, a total of $47.2 billion redirected straight into metal. And these were not desperate retail traders or speculators chasing headlines. These were the most connected names in China's elite financial class. Pony Ma reduced his US holdings by 40% and shifted $2.1 billion into gold. Jack Ma exited his remaining positions in Amazon and Meta, reallocating $890 million into gold. Wang Jianlin liquidated his entire US portfolio and moved $1.7 billion into gold. These individuals don't guess. They act on information pipelines that run through China's largest manufacturing networks, its state-controlled banking system, and its intelligence-driven economic apparatus. But what makes this moment even more unnerving is the speed of the reversal. Just 12 months earlier, in Q3 2024, Chinese investors were net buyers of US stocks, adding $23 billion. In 1 year, sentiment swung from plus $23 billion to $47 billion, a $70 billion shift in behavior. And for the first time in 40 years, since the era of Deng Xiaoping, the long-standing trend of Chinese capital flowing steadily into America didn't just slow, it flipped. They stopped buying dips. They stopped treating US downturns as opportunities. They started exiting outright. That kind of reversal doesn't happen for cosmetic reasons. It happens when the people closest to the global supply chain, closest to the credit markets, and closest to the intelligence data decide that the system they've trusted for decades is about to break. In 2007, Western media missed the single most important early warning of the financial crisis, and the same pattern is now reappearing with even greater force. Between Q4 2006 and Q2 2007, Chinese investors quietly sold $31 billion in US equities. At the time, nobody paid attention. CNBC didn't mention it. Bloomberg buried it in a one-paragraph footnote. Analysts dismissed it as harmless rebalancing. But the timeline that followed was chilling. June 2007, the Bear Stearns hedge funds collapsed. August 2007, credit markets froze. October 2007, the S&P 500 peaked at 1565. September 2008, Lehman Brothers died. March 2009, markets bottomed at 6 down 57%. From the moment Chinese elites began selling US assets to the deepest point of the crash, the distance was just 28 months. And here's the uncomfortable truth. Chinese billionaires were early not because they were lucky, but because they had information advantages that American investors simply didn't. They had access to real-time manufacturing data. When major US retailers like Walmart and Target cut Christmas orders in late 2006, Chinese factory owners saw it instantly, months before it appeared in US earnings reports. They had insight through banking relationships. Chinese banks were on the other side of subprime mortgage trades and noticed loan quality collapsing long before American pension funds realized anything was wrong. And they had government intelligence. The Chinese state tracked shipping flows, satellite imagery of US ports, credit data, and inventory levels with extraordinary speed. They saw the slowdown before economists even ran the numbers. In 2025, that same trio of intelligence pipelines, factory data, bank exposure, and state-level monitoring, is flashing red again. AI chip orders falling 22% quarter over quarter. US debt at $35.7 trillion and climbing. Dollar reserve share slipping from 62% to 58%. Chinese elites are not guessing the system is stressed. They're watching it stress in real time. And just like 2007, they are rotating out of US assets 12 to 18 months before the danger becomes undeniable. In 2025, the most revealing signal of all doesn't come from stock charts, inflation prints, or Federal Reserve speeches. It comes from the factory floors of Shenzhen, Guangzhou, and Suzhou, where the global AI supply chain lives and breathes. Chinese manufacturers produce the servers, GPUs, power systems, cooling units, racks, and infrastructure used by NVIDIA, AMD, Microsoft, Amazon, and Google. And, according to data from the China Semiconductor Industry Association, AI-related chip orders collapsed 22% in Q3 2025, the first decline since the launch of ChatGPT in late 2022. This is the kind of real-time economic shock that Chinese elites see months before it becomes visible to American investors. When a hyperscaler cancels a major order, the factory feels it instantly. But US investors won't learn about the slowdown until Q4 2025 or even January 2026, when earnings season exposes the damage. That lag is exactly where Chinese billionaires gain their edge. They're not reading analyst notes. They're listening to their factory managers saying, NVIDIA just cut next quarter's order. Amazon paused procurement. Microsoft reduced forecasts. This is the same early warning system that detected the 2007 slowdown long before Wall Street saw it. And it isn't just manufacturing. Chinese investors are trained by history to detect sovereign debt crises early. They've studied the collapse of Japan in 1989, the Asian financial crisis in 1997, and the European debt crisis in 2011. And today, they're watching the US cross the same lines. With US federal debt at $35.7 trillion, GDP at $27.4 trillion, and debt to GDP at 130%, Chinese elites see the mathematical reality. America is moving down the same slope that led Japan into stagnation and Greece into collapse. And layered on top of this is something even more sensitive: asset-seizure risk. After the US froze $300 billion in Russian assets, sanctioned Chinese tech firms, and ordered the forced divestment of TikTok, every billionaire in Beijing realized the uncomfortable truth. Their wealth inside the United States is no longer guaranteed. Stocks can be sanctioned, bank accounts can be frozen, real estate can be seized. But gold stored in Singapore, Hong Kong, or Switzerland? Untouchable. Add to that the accelerating decline of the US dollar's reserve share from 62% to 58% since 2020, and the massive surge in global central bank gold purchases, and Chinese billionaires see what may become the final stage of a long cycle. a world where dollar dominance slips, global trust fractures, and gold regains the role it always takes during financial resets. This is why they are not buying tech, not buying bonds, not buying real estate. They are buying metal, because the four forces they see converging in 2026 are the same forces that have preceded every major global financial correction in the modern era: an AI demand slowdown, an unsustainable US debt trajectory, geopolitical weaponization of assets, and the early stages of dollar devaluation. And when all four pressures rise together, the richest people in China aren't diversifying, they're evacuating. In every major financial unraveling of the past century, capital never flees all at once. It escapes in waves, each bigger and more panicked than the one before, and 2025-2027 is now aligning with that historical script almost perfectly. What Chinese billionaires are doing in Q3 2025 is the textbook beginning of Wave 1, the phase where the smartest, most deeply connected investors reposition quietly while markets are still calm. Their $47.2 billion move into gold didn't trigger headlines because it was executed slowly, strategically, and during periods of strength rather than weakness, precisely so it wouldn't alert the broader market. This is the same behavior that preceded every major correction: discreet selling at the top while retail investors celebrate new highs. But where things become truly dangerous is what comes next. Wave 2, historically, begins when institutions, hedge funds, mutual funds, pension funds, finally detect the slowdown that China's elites saw months earlier. In 2026, as AI earnings disappoint, credit conditions tighten, and US debt servicing costs explode past $1 trillion annually, these institutions will have no choice but to de-risk. Forced selling cascades, redemptions accelerate, liquidity evaporates. This is the moment when markets don't fall gradually, they gap lower. A $500 billion to $1 trillion institutional exit is what transforms a correction into a crisis. And it's the phase where gold historically surges as capital stampedes towards safety. And then comes Wave 3, the phase no one wants to face. This is when ordinary investors, 401k holders, retirees, Robinhood traders, finally realize the market isn't bouncing back. It's when the news cycle turns from temporary volatility to systemic risk, when fear replaces denial, and when retail investors sell at the exact bottom. In 2008, this was when the S&P 500 plunged to 666. In 2000, it was when the NASDAQ collapsed 78%. In 1929, it was when Americans lined up outside banks that no longer had cash to offer. And today, the setup is even more fragile. Global debt is higher, valuations are richer, inflation is embedded, and geopolitical tensions are escalating instead of calming. Chinese billionaires understand this rhythm instinctively because they've lived through crises that the West only read about. They watched the Asian financial crisis dissolve currencies in months. They witnessed Japan's 1989 collapse turn the world's second largest economy into a 30-year stagnation case. They studied how governments weaponize financial systems in moments of geopolitical conflict. So when they begin Wave 1 by pulling tens of billions out of US markets and loading it into vaulted gold, they're not speculating. They're bracing for the mechanical progression that history has taught them is coming next. The window between Wave 1 and Wave 2 is always the last narrow chance for ordinary investors to reposition. Once institutions start selling, the door closes, and by the time retail panic erupts, the bottom is already forming. This is the cycle Chinese elites are front-running, the same cycle that ended in disaster for those who ignored it in 2000, 2008, and 2020. In moments like this, when the smartest capital in the world is repositioning long before the headlines catch up, the question for ordinary investors isn't whether a crash is coming, it's how to survive it, and more importantly, how to emerge stronger on the other side. Chinese billionaires aren't divesting $47.2 billion in US stocks because they're bearish on America as an idea. They're doing it because they understand one principle that has governed every financial reset for the past 100 years. The people who protect capital during the downturn are the ones who multiply it during the recovery. And their playbook for 2026 is remarkably consistent with this principle. First, they are treating gold not as a speculative bet, but as the core insurance layer of their wealth. They understand that when debt reaches 130% of GDP, when interest costs exceed $1 trillion, and when the dollar's reserve share slips from 62% to 58%, the primary risk isn't market volatility, it's currency volatility. Gold is the only asset that preserves purchasing power when governments choose inflation over default, a choice historically made again and again because it's the only politically survivable option. That's why the world's central banks are buying hundreds of tons of gold, why the People's Bank of China added 78 tons in a single quarter, and why China's private elite are following suit. Second, they're de-risking the sectors most vulnerable to an earnings shock, especially AI-linked megacaps whose valuations depend on relentless demand growth. When Chinese factories, the heartbeat of the AI supply chain, report a 22% drop in chip orders, billionaires don't wait for Wall Street research notes. They rotate out immediately. Third, they're increasing liquidity. While retail investors chase rallies, Chinese elites are raising cash to prepare for forced selling in Wave 2 and the final capitulation of Wave 3. Cash isn't a retreat, it's ammunition. When institutions liquidate at scale and valuations compress 30–40%, cash becomes the tool that separates those who stabilize from those who spiral. But the most important reason they are front-running 2026 is one Western investors rarely acknowledge: financial weaponization risk. After the US froze $300 billion in Russian assets and targeted Chinese companies with sanctions, the message was unmistakable. Wealth inside US jurisdiction is no longer guaranteed for foreign elites. Physical gold stored in Singapore, Hong Kong, or Switzerland is beyond political reach. And that single fact makes gold not just a hedge, but a survival asset. Taken together, the behavior of Chinese billionaires paints a consistent picture. They expect the next 12 and 18 months to deliver a convergence of stresses that the American financial system can no longer absorb without a break. A combination of slowing earnings, rising debt costs, embedded inflation, geopolitical retaliation, and an increasingly fragile currency regime. Their strategy is not fear-driven, it is cycle-driven. It is the same strategy used by those who dodged the 2000 dot-com collapse, the 2008 financial crisis, and the 2020 pandemic shock. It's a strategy built on accepting that markets rise slowly and fall suddenly, that liquidity disappears faster than anyone expects, and that the window to reposition always closes before the crowd even knows it opened. And right now, in late 2025, that window is closing again. From a broader expert standpoint, what Chinese billionaires are doing in 2025 aligns with warnings coming from some of the most respected macroeconomists, political risk analysts, and former central bank officials across the US and Europe. And what makes their combined perspective so alarming is that these experts are not looking at the same indicators, yet they are all arriving at the same conclusion. The global financial system is entering a phase in which the traditional shock absorbers no longer work. Former Federal Reserve and ECB policymakers have been increasingly candid about a reality that markets prefer to avoid. The US is now so indebted that fighting inflation through higher interest rates has become mathematically impossible to sustain. When total federal debt was $10 trillion in 2008, the Fed could raise rates aggressively without crippling the government's finances. But with debt now exceeding $35 trillion, every percentage point of additional interest burdens the US with more than $350 billion in extra annual payments. As former New York Fed official Peter Fisher put it, the US has crossed into a zone where fiscal dominance takes over, meaning monetary policy becomes subordinate to the government's inability to service its debt without printing money. That, in turn, essentially guarantees higher structural inflation in the years ahead, no matter what the official CPI numbers temporarily show. And inflation is exactly the kind of force that gold thrives on. Meanwhile, macro strategists like Lynn Alden, Luke Gromen, and Zoltan Pozsar have been warning that the post-2008 architecture of global finance has reached the point where it cannot adjust to tighter money without breaking. The financial world that emerged from the last crisis is dependent on cheap liquidity. Corporations refinance trillions at artificially low rates, governments rolled debt using short-duration maturities, and global trade cleared through a dollar system that assumed stability. Once interest rates rose sharply in 2022-2024, that entire structure came under strain. Companies face refinancing cliffs, governments face exploding interest bills, banks are pressured by unrealized losses, and the dollar is pressured by foreign nations seeking alternatives. This fragility explains why strategists believe the next major policy shift, whether in 2025 or 2026, won't be a gentle, soft landing. It will be a forced return to monetary easing, not because the economy is weak, but because the debt load is unfinanceable at current rates. And when easing returns, inflation will not fall, it will rebound. This is exactly the environment where global elites historically flee paper assets for hard ones. Political risk analysts add a different dimension that mainstream financial media continues to underplay. The geopolitical environment is shifting toward financial retaliation, something that rarely shows up in economic models until it's too late. After the US and EU froze more than $300 billion in Russian reserves, sanctioned Chinese tech firms, forced the divestment of TikTok, and signaled the possibility of further restrictions in strategic industries, wealthy individuals in China and in several other nations learned a lesson that will shape global capital flows for years. Money held inside Western systems is no longer purely an economic asset, it is a political vulnerability. This is why political risk specialists, including those at Eurasia Group and Chatham House, now argue that capital relocation into neutral jurisdictions, Singapore, Switzerland, the UAE, and into non-seizable assets like gold is not a short-term trade, but a structural realignment. For foreign elites, the risk is no longer market losses, it is asset capture. Gold is the only major store of value with no counterparty, no jurisdictional anchor, and no exposure to geopolitical retaliation. Demographers also point out a force rarely discussed in financial commentary. Aging populations across the US, Europe, China, and Japan are simultaneously straining entitlement systems at the exact moment debt is exploding. When tax bases shrink and liabilities grow, governments rely increasingly on monetary inflation, a silent form of wealth transfer, to manage obligations. That process is slow at first and then accelerates suddenly, exactly as it did in the 1970s. The combination of deteriorating demographics, rising fiscal deficits, and political gridlock creates the perfect setup for a multi-year inflation regime, again reinforcing why gold is being accumulated so aggressively by both central banks and private wealth. And then there is the structural issue that market historians emphasize. Markets do not crash because one thing goes wrong. They crash when several fragile systems fail at the same time. In 2025, experts see these stress points converging, slowing corporate earnings as AI. Demand cools, geopolitical fragmentation between the US and China, fiscal deterioration driven by unsustainable debt costs, and weakening global trust in the US dollar. Any one of these risks would be manageable on its own. But when they converge, the system enters a phase that Dalio calls the late stage of the long-term debt cycle, where inflation, currency instability, and capital flight become the dominant economic forces. What experts find most concerning is not simply that Chinese billionaires are buying gold, it's that central banks worldwide are doing the same thing. In Q3 2025, they bought 337 tons, with China, India, Poland, and Singapore among the most aggressive buyers. When the institutions responsible for maintaining currency stability are hoarding gold, it signals a profound loss of trust in the longevity of the current monetary order. Put all these expert perspectives together, and the picture becomes clear. Wealthy Chinese investors are not acting alone, and they are not acting irrationally. They are simply among the first to respond to a global system showing the same symptoms that have preceded every major financial reset of the past century. They're positioning not for volatility, but for transition, from a dollar-dominated world to a multipolar one, from cheap debt to expensive debt, from artificial stability to historical reality. And just like in 2000, 2008, and 2020, the people who move early will survive. The people who wait for confirmation will not.